Hi, researcher Uncle Dan here. Location the lab. Today we had an interesting session, option expiry. This was a curious day because of the volatility that we saw in Amazon. And for some reason it felt like the implied volatilities were just too low for the options. So it made for some interesting trades. So let's look at the trades we did in Amazon today. If you have questions, put them down below as usual. Yeah, today was a crazy day for Amazon. It was a lot of fun. But let me start by just reminding you, day trading on expiry is super risky and it's pure gambling. If you engage in this kind of activity, you will lose money. I've been doing this for 40 years and I can still lose money doing this. Now, there's a few rules that I apply. My main rule is manage my risk at order entry. Any amount of money I pay for an option, I'm willing to lose it all, and it will be lost within a very short period of time. The option we're doing in Amazon today is a one-day expiry. Yes, we made 300 and 400% within minutes today, but you have to understand that when you get it wrong, you are wiped out. So you really have to manage your risk up front. There are no stop losses. Whatever you pay for your option, if you're wrong, it's gone. So the trick here is to make sure you always put in profit limit orders in. Don't wait till the market's moved up and then let your order pass through Citadel, who's the market maker, because they're going to take advantage of you. That way, your order's sitting at the matching engine, not sitting in Citadel's office waiting for them to decide whether they can, take advantage of the latency that you suffer from. So those are the basic rules. Real quick, let me walk you through what happened. Here's the price of Amazon stock today. Okay, so as we look here, you can see the stock actually went up early. It's about 11 a.m. The stock went above 3,300, which is the main price point. So I just made a guess, not like I know anything. I just decided right here that I would take a chance that we drop. And so what I did is about a 32.70 put, and I paid $2.80 for it. Amazon was at 33.06. Within an hour, the market started to drop. Now, look what happened. This blue line is the implied volatility. So when the implied volatility goes up, all the options become more expensive. As the market dropped from 33.06 to 32.75, I decided to take profits right here. Now, it's not that I knew the market was going to bottom here and rally back up. What I did is I set a target of 3 times profit, and I left an order in the platform, and I was filled right here. Now, I could have sold it for more, but that was my target. And then after that, the market rallied back up. But you see this implied volatility jumping up. When you get IV going up and the price is going in your direction, you can make a lot of money very quickly. But once that implied volatility starts to come down, you're going to lose it all. During lunchtime, we normally see the implied volatilities flatten out and drop. So I did nothing during this time because there's a high probability that IVs will come down. And if you're long options, you don't want IV to drop. Now the IV started to drop, okay? And just after 2 p.m., I decided to take a chance that we would bounce back up. So with the implied volatility back down, pretty much where it was earlier in the day, I went ahead and bought a call, about a 32.80 call on Amazon. All these options expired today. Within 10 minutes, the stock jumped 10 points, okay? But look what happened to the implied volatility. The IV is still dropping. So I'm not going to make as much money when the IV is dropping. So when this moved 10 points, I had stepped away from my screen. And what do? When you're not near your screen, you always leave a profit limit order in just in case something happens. Within those first 10 minutes, before I even had a chance to come back, some algos came in and pushed the price up, and I got taken out at $10. So I made a 40% profit on that call in 10 minutes. The market peaked and kept dropping back down. Now, in the last hour of trading, I decided that there's a good chance, based upon what's happened over the last 5 weeks, we'll see some kind of rally into the close. So just after 3 o'clock, I noticed that the implied volatility was bottoming out right here. And I thought this huge drop in IV, perhaps this was an opportunity now for IV to jump back up. So what I did is I went back into the 32.80 call, but this time, instead of paying $7.50 for it, I only paid $2. I paid $2 right here for the 32.80 call when Amazon was 32.64. But I got it wrong. The stock kept dropping. So the stock is dropping and it made a new low. Now, when it made a new low, I saw that there was an opportunity to buy another call for $2. So it wasn't the 32.80 call, it was actually the 32.60 call for $2. And I thought, wow, that's really cheap. By buying the 32.60 call, I now have a 32.80 call, a 32.60 call. And what is that? That's a barbell. But I have another video. You can look up there. There's a link to that video. And you can go back and learn what the barbell is. And I had approximately 20 minutes before the market closed. Not a lot of time. You have to be very careful. If you own an option and if it's in the money, when the market closes, you'll be obligated to own the shares. And we're talking about a very expensive stock. Each option is worth 100 shares of a $3,280 stock, right? So that's a lot of money. $328,000 per call option. And we just paid $2 times 100 shares. In other words, we just paid $200. So in this particular case, with the stock almost at its low, I bought the 32.60 call for $2. And within a few minutes, the stock jumped $10. But look at the implied volatility. Instead of going down, the implied volatility spiked. IV shot up. The price shot up. The opposite of earlier with the 32.80 call, where the price went up by $10, but the IV went down. In this case, we only made a 40% return. But here, price went up and the IV went up, and we made a 400% return on our investment within 10 minutes. Now, in this case, I still own the 32.80 call, and that's the beauty of the barbell. With the barbell, you take profits on the in-the-money call, and you make sure that the profits covers the cost of your other call, the 32.80 call, and you make a nice profit. So I paid $2 for each, so I'm in for $4, and I sold it for $8. So I made a 100% return, and I still own a call, the 32.80 call. If Amazon wants to shoot up to $3,300 into the close, and it's done it very many times, then I can still make another 10 times return on my money. So I'm leaving myself that opportunity to make a lot more money, but I'm still locking in a reasonable profit of 100% after a few minutes of trading. So that's what we did today in Amazon. It was a very lucky day. It doesn't always happen, but we did lose on one. So we made on 3, we lost on 1. And what do I always say? What are the rules? Limit your losses, but let your winners run. Make sure your winners are many multiples of your losers, right? So in this case, we lost 2. We made $8.40 on one. We made $10 on another, and we made $8. Each time we sold these calls, they were for a lot more money than what we bought them for. And that's the secret. Limit your losers, let your winners run. So happy hunting.